Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another review of velocity banking. So, have you ever heard on the internet that you should replace your mortgage with the first lien home equity line of credit? Well, there was a person who actually emailed me that he was considering replacing his 2.3% mortgage with the first lien 9% home equity line of credit. And so what we're going to do is I'm not going to tell you whether this is a good idea or not. We're going to do the math, right? We have to do the math. Now, there is someone out there who says it's not a good idea, and that actually is Harsh Gill, who was the originator of the idea of using a line of credit or a home equity line of credit to pay off your mortgage. It's from the book How to Own Your Home Years Sooner from 2003. And basically, he says it's a disadvantage because you're exposing your entire loan amount to the variable interest rate. And then what he says his recommendation is to take out a smaller HELOC as a second mortgage, right? So he doesn't say do a first lien HELOC, he says do a second lien HELOC. And the only reason that for me personally, I would have a first lien HELOC is if my mortgage is paid off, which it is right now, and I'm currently in the process of getting another one, right? So look it up, look up his book if you want to see what he talks about. But he says, hey, you don't need a first lien HELOC. You're exposing your loan amount to the entire variable interest rate. And he says that this option has major advantages over the first option, which is loan replacement. Now, like I said before, the most important thing that we have to do is the math, right? Which is what we're going to do here. We're going to show the difference between mortgage replacement and not replacing your mortgage and doing the option two, which is what Harj is talking about, and see what comes out better. Now, here's the thing. We're not just simply replacing our mortgage, this cheap mortgage in this scenario. We're also going to replace all of these credit cards. So we're dealing with 27 or 19 to 30% credit cards. So we can clearly see that there's a benefit of replacing these with a 9% HELOC. But what about the mortgage? And so should we do it in little pieces or should we dump the whole thing in a 9% HELOC? We're going to go ahead and review that. And so what is velocity banking? Well, velocity banking is using a line of credit as your main tool to help you pay off debt, right? And there's three goals to this is to pay the debt off quicker, pay less interest, and most importantly, maintain our control of our money, right? We got to accomplish these three things. And so some of you might be thinking, well, if I have some extra cash, and in this scenario, we have negative $110 of savings, so we don't have any extra cash. But if we had some extra cash, I'll just directly throw it into the loan. Or if I had an extra $2,000 or $3,000, I'll just dump it directly into a loan. You can do that, but most people won't do that because they're afraid of option or goal number three, or not achieving goal number three, is that we don't maintain control of our money because a loan is a one-way street, right? Really important to understand of human behavior and psychology. A loan is a one-way street, which is why they're actually priced cheaper than lines of credit, right? So kind of think of it as a Netflix membership that's the cheapest ever, maybe $199 per month, and then you can only watch it from 1 a.m. to 6 a.m. Nobody's going to take advantage of that, right? This is why nobody overpays a loan. Anyways, so let's go ahead and demonstrate both use cases. And so the first use case is the mortgage replacement. So what we're going to do is we're going to assume that we have access to a huge home equity line of credit. We got $300,000 mortgage here. Let's go ahead and replace everything with a $500,000 home equity line of credit. So we assume two things: same income, no savings. We go from negative to zero, always to zero. And then let's go ahead and copy this information, right? And then what we're going to do is I'm going to do income minus expenses, right? But because we're replacing all of our debt with a first lien home equity line of credit, all of these will go to zero, right? And we have to transfer this debt. So if you sum it up, and I'll sum it up for you, this is $467,000 of debt. So $167,000 in credit card debt, and then $300,000 in the mortgage, okay? So once we transfer that debt, guess what? These all go to zero. So I'm doing this really quickly, but you can see we went from negative $110 to $6,500 of cash flow. So pretty impressive, right? But remember, we always have to do the math, okay? So what we're going to do, and let me go ahead and zoom in on this so you can see this better, is that we're going to calculate what the next month's balance is, and also we have to calculate the interest. So that's going to be the previous month plus 1, and then this one, the balance is the previous month's balance plus the previous month's interest minus our cash flow number. So I think it's 6,500. Pretty good, right? But again, we're calculating the interest on this whole $467,000, or the average of it. So let's go ahead and get the average of these two numbers, the average daily balance, it's an estimate, and then multiply it 0.909, 9%, and then divide by 12. So 9% is the annual interest rate quoted here, but then we calculate the interest monthly, so we divide by 12, right? And as you can see here, we're paying about $3,000 of interest a month, okay? So we are actually positive cash flowing because, again, one of the big things that we're doing that's a positive to us is we're putting that $167,000 that's basically from 19 to 30% interest, putting in a 9% line of credit, right? So that's good for us. And then all we got to do is just essentially copy and paste these formulas. And then so if we scroll down and let me zoom out, so we can see here that the balance of the line of credit is going down, right? And we can just see right here and down, 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 down. And then, so again, the balance is reducing, right? And then we see that in month 103, that this is pretty much paid off, right? 103. So, well, yeah, 103. So what we can do is, let me go ahead and erase all of this, is that we can basically write down the milestones. So first thing that we want to do is sum up this total column, right? So if we do this and do this button right here, it's going to tell us how much interest we paid in total. So we paid 201 grand in interest in 103 months. So how much is 103 months? That's 8.58 years. So let's go ahead and copy these numbers and put them to our milestones of if we're comparing a mortgage replacement. Let's see, so let me go ahead and copy this. Okay, so basically it took us 8.58 years to pay off all of our debt, and we paid 201K of interest. Now, I like the 8.58, but the 201K of interest, I mean, I guess it's okay, but I don't feel, I don't really feel too good about it, right? Seems like a lot to me, even though we did pay off all of our credit card debt at a much lower interest rate, but we moved that mortgage from 3 to 9, right? So let's compare it to the no replacement scenario, meaning maybe we have a second line of credit or a home equity line of credit, second lien, maybe at, we'll say $200,000, right? I don't think we, so does it have to be a first lien? No. So you can see from Harge's book that, or that he said just use a second lien home equity line of credit. So now if we have $167,000, so let's go ahead and do this one more time, right? We're going to move simply this credit card debt to the line of credit, which we'll do right now. So 167,000, right? And I screwed up here, so now I gotta do savings. Or maybe I should just take this away, but this column lets us know, hey, if we have any emergencies, this is the amount of savings that we really have available, right? But let's go ahead and do this and do the same math, right? So the next month's is going to be J2 plus 1. The next month's balance is going to be the previous month's balance plus the previous month's interest minus our cash flow. So again, we paid off everything except for the mortgage, and I forgot to do this. So screwed up, but let me go ahead. We replaced only the credit cards, so 0, 0, 0, 0, 0, 0, 0, 0, 0, 0. We leave the mortgage for last, right? Because it's 3%, and we pay it off last. We have $5,235.19 of cash flow. So that extra additional cash flow, again, we have to pay $300,000 to get it. So let's just leave that for now and just pay off the credit cards, right? So let's do this one more time again. So the next month's balance is the previous month's balance plus the previous month's interest minus that 5,000 and something cash flow. So 5235.19. Okay. And then what we do is we take the average daily balance. Let's go ahead and do that. Take the average daily balance, multiply it by that 9% interest rate, and then divide by 12. And then, as you can see here, based on what we pay for the credit cards, our interest is about $1,000 a month now. Okay, so let's go ahead and pay this off, all of these credit cards off, right? And then we can see right here, it takes us about, 36 months to pay it off, right? So that's about 3 years. And let's go ahead and sum it up. So if we sum up the interest, right, that's 23 grand, so 23.6 grand and 36 months. So let me go ahead and copy these figures, okay? And I'm going to do this, right? And we're going to do this right here. So this is going to take us, just for the credit cards, 36 months. Well, let's just say 3 years, right? And then 23.6K of interest, okay? Now let's go ahead and do the mortgage. And if you don't know how we do the mortgage, basically we do something called chunking, right? Which is taking moving pieces of the loan into the line of credit. So for example, we could do $9,000 or $10,000. So if we do $10,000, we would just move $10,000 to here. It would probably be here. And let me do this. Add $10,000. Our cash flow still stays the same, right? And then we rinse and repeat over and over again. So this is where we placed it, and then in 2 months we did it, and then just do it over and over again, right? And then that's one way in which we can pay off the mortgage with no replacement, just using that line of credit over and over again as a way to pay it off quicker, pay less interest, and maintain control of our money and not segregate our income. Because if we segregate our income, there's no control of our money, right? So let's go ahead and calculate this. Now, luckily, we have the velocity banking calculator to calculate how long it will take. So it's kind of like a cheat sheet, but I got to make sure that I do this correctly. So here, okay, so here I got to just calculate, and hopefully I got everything right. Not here, this isn't right. So 300,000 at 3%, and this is at 3 years, so that's 36 months, right? So we can see how much we paid in interest, 26 grand, and what the current balance of the loan is. So all I got to do is just pop up the velocity banking calculator and fill it in. So give me one moment to bring that up, and velocity bank calculator. And do we have it open right now? Yes, we do. And so now all I got to do is just copy some of the figures. Uh-oh. I screwed up. Did I screw up? Uh-oh. 1 second. We're going to copy it from one screen to another and then copy it to the velocity banking calculator sheet. Okay, so let me go ahead and show you this, right? And switch screens. Okay, there we are. All right, so basically with this cool calculator, you just fill in the numbers of what the original balance is, the current balance, payment terms, and how much you're moving to the line of credit. And so you can see right here, it's going to take us 3.9 years to pay it off. And we only pay 18 grand of interest, whereas if we replace the whole thing, 280,632.48, we pay more interest and in time and interest, right? So if we do it the other way, we only pay 18 grand, but if we replace the whole thing, 280,632.48, 2.48, we pay 60 grand. So which one do you want? You want to pay, leave at least 30 grand or 40 grand on the table? and time, I don't want to do that. So I'm going to do the chunking method, $9,000. And if you want to know where I got this calculator, I got this from Renatus. So this whole YouTube channel is just a sales funnel for Renatus products. So full disclosure, and I'm an independent contractor marketer. Anyways, so 18 grand right here. So let's go ahead and copy these figures of 3.9 years and 18 grand. So let's go ahead and move to the other spreadsheet. And then here. And so what we have to do is actually do two things. We got to copy this interest, right? So that's 26 grand, and add it to the additional interest from that line of credit that we're using. So there'll be this one right here. And let me copy this, right? And then let's go ahead and sum it up. So data, home, sum. Okay, so basically, in order to pay off the mortgage in total, it took us 44 grand of interest, right? So 44 grand. And then we're going to go back right here. So mortgage, okay, we'll say 44K. And how long did it actually take us to pay off well, the mortgage itself is, give me 1 second, an additional 3.9 years. So we could put 3 years and 3.9 years. So 3.9 years and 44K of interest. So in total, let's go ahead and sum this up. So the total amount of years it took us is 3 plus 3.9. So that's 6.9 years. Okay. And then 44 plus 23.6K of interest. So that would be 67.6K of interest, right? So again, we're just comparing both strategies with the HELOC. So it's really important not just having the tool, but understanding the most efficient way of using the tool, right? So would you pay, how much is this? 201 minus 67.7. You're leaving $133,000 of interest savings off the table if you do a full mortgage replacement on a loan that's 3% to 9, right? So I don't know about you, but I don't think it's necessary. Like, that's like, how many Teslas is that? How much is a Tesla? 30, 40 grand? So maybe, I don't know, four Teslas? I don't even want a Tesla, to be honest. In fact, I haven't even bought a car in ever, because I just had hand-me-downs in my car. 2003 Toyota is going pretty well. So this is what I'm saying. So basically, you can see here that the no replacement, not replacing your mortgage with the HELOC, is superior if you're going to use your home equity line of credit as your main tool to pay off your debt, right? So again, this is why it's really important to understand the strategy and not just dump debt into a line of credit, right? So to conclude, right? So why don't we just ask ChatGPT if this is a good strategy or not? So let me go ahead and open up ChatGPT right here. Or is that ChatGPT? Okay. So now let's just ask in simple terms, do you think, or can you explain if replacing a 3% mortgage with a 9% HELOC to do velocity banking is a good idea or bad idea? All right. So basically, the Chat GPT knows like what we just saw on the Excel sheet. But let me go ahead and read it, or read out loud using this enthusiastic young person's voice.
Replacing a 3% mortgage with a 9% HELOC to do velocity banking is generally not a good idea. Here's why. 1. Higher interest rate. A HELOC, home equity line of credit, with a 9% interest rate is much higher than your current 3% mortgage rate. This means you'll end up paying more in interest, which defeats the purpose of velocity banking. 2. Interest calculation differences. Mortgages usually have fixed monthly payments with a mix of principal and interest, while HELOCs often have variable rates and interest-only payments initially. At a 9% rate, your interest costs can quickly accumulate, especially if rates rise further. 3. Risk of fluctuating rates. HELOC rates are often variable, meaning they can increase over time. If rates go up, so will your interest costs, making your debt more expensive to manage. Bottom line, it's usually not advisable to switch to a loan with a much higher interest rate. Velocity banking aims to save interest costs and pay off debt faster, but using a 9% HELOC to replace a 3% mortgage would likely result in higher costs overall.
Right. And one of the things that we have to understand, which is not mentioned in this ChatGPT response, is that the mortgage, when you pay it off, provides such little cash flow. So there are some instances where we might pay off a lower interest rate debt, but because we get so much cash flow for paying off that lower interest rate debt, it won't, let's say, necessarily affect or negatively affect us paying off the debt quickly, right? All right, well, that's it for today. So, again, if you ever thought of the idea, and the reason I do this is because someone actually emailed me. I know I mentioned this in the beginning of the video, that he wanted to replace his 2% mortgage with a 9% line of credit, right? Wanted to do that. So, again, do the math. That's the most important thing. All right, well, that's it for today. Have a great day, everybody, and we'll speak next time.